Before we begin this week's episode of the Grow Your Wealthy Mindset podcast, I want to tell you of a great guide that I made just for you. It's the 12 financial mistakes that keep physicians from building wealth. After talking to hundreds of physicians, I've heard many mistakes, and these are the ones that I thought were most important to share so that you can potentially avoid making these mistakes, or if you've already made them, learn a bit about how you might be able to recover. You can grab the guide at my website, www.growyourwealthymindset.com/12 financial mistakes. Now on to this week's episode. Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Zhang. Hello, and welcome back to the Grow Your Wealthy Mindset podcast. With our progressive tax system in the United States, the higher the W-2 income, the higher the percentage of income is paid in taxes. Anything we can pay with pre-tax money means getting anywhere between a 22% and 37% discount depending on our marginal tax rate. A flexible spending account, or FSA, is a tax advantage savings account offered by employers that allows employees to set aside pre-tax money to pay for eligible health care and or dependent care expenses. This is a way to reduce taxable income and save on taxes. I discuss healthcare FSAs in episode 137 of the Grow Your Wealthy Mindset podcast. The title of that podcast is Flexible Spending and Healthcare Savings Accounts. In this episode, I'm going to focus on the Dependent Care Flexible Saving Account, which can be used to pay for eligible dependent care expenses such as childcare or elder care. The rules around dependent care FSAs can be nuanced depending on your situation and circumstances. I personally do not have any children or dependents, so I've been reading the IRS website to ensure I bring you accurate information. I am not a CPA, so do not take this as professional tax advice. And honestly, it's probably your HR department that can help you out the most to determine if an expense is eligible to answer any questions you may have about your employer's plan. If you're going to use a dependent care FSA, then you need to have someone who qualifies as being your dependent in your care, that you have expenses where paying those expenses with pre-tax dollars actually makes sense. In general, there are three main requirements to determine whether a person in your care actually qualifies. The first is that they are incapable of self-care, and this can be a child or an adult. Age is not actually a consideration. That being said, the IRS considers teenagers of being capable of self-care. So once your child turns 13, they would no longer qualify unless they are actually physically or mentally unable to care for themselves because of a specific condition. This means that all children 12 and under do qualify, even if your 12-year-old probably is able to take care of themselves. Disabled spouses or a disabled parent that's living with you that you can claim as a dependent on your taxes would also qualify. The second criteria is that the person must live in your home for at least 8 hours a day. They cannot be living in a nursing home or go to a boarding school for their education. That's not so common with kids under the age of 13 in the United States, but I'm sure that happens. The third criteria is that you can claim the person as a dependent on your income taxes. Most people listening to this podcast would likely use a dependent care FSA to cover eligible expenses for their young children, meaning children under the age of 13. If married, to qualify for the tax deduction, both parents must work and earn at least $5,050 a year. If one parent does not work, then they must either be in between jobs and actively looking for work, or be a full-time student, or be disabled themselves. Unfortunately, this means that there is no reimbursement that would allow a stay-at-home parent to get a babysitter so that they can run errands without taking the child or children with them. Dependent FSAs are a benefit provided by employers. If you elect to participate in your employer's plan, you'll choose how much money to contribute that will be taken out of your paycheck each pay period and then deposited into an account, which unfortunately also does not bear interest. Then you can submit to be reimbursed from this account for eligible expenses. Unlike with healthcare FSAs, where it is possible to pay directly out of the account by using a debit card linked to that healthcare FSA account, dependent care FSAs require you to pay costs upfront and get reimbursed after submitting the proper paperwork. Generally, you will need a receipt that provides specific information to get reimbursed. The receipt needs to have the name of the person who received the service, the provider that delivered the service, the date of service, the type of service, and the amount paid for the service. The maximum you can contribute per calendar year from January 1st to December 31st, or for the plan year, which is from July 1st to June 1st, is $5,000 per household, which applies to a household of a single adult or for those who are married filing jointly. If you are married and filing jointly, as I mentioned before, both you and your spouse must work and earn income unless one of you is between jobs and actively looking for work, or is a full-time student, or is disabled and unable to work. Basically, the point of having this benefit is for adults to be able to work and to offset the expenses of working due to needing someone to take care of qualified dependents. If you are divorced, things get a little bit more tricky. Only the custodial parent may use a dependent care FSA. Per the IRS, the custodial parent is the parent with whom the child lived for the greater number of nights. If the child was with each parent for an equal number of nights, the custodial parent is the parent with the higher adjusted gross income. Then there are other details and exceptions for a parent who works at night, which I won't get into here. This means that even with joint custody, both divorced parents cannot use a dependent care FSA unless each parent has custody of a child. For example, if you and your ex-spouse have 2 children and you have 1 child in your custody and your ex-spouse has 1 child in their custody, then this is a situation where both of you can qualify for a dependent care FSA and contribute up to $5,000 per household, which means you can contribute $5,000 for your household and your ex-spouse can also contribute $5,000 for their household. Of course, this assumes that both of you are working. If you file your taxes as married filing separately, then each parent is limited to a $2,500 contribution. In the case that you have 2 children and have shared custody, and the children stay with each other all the time, then it is going to be the parent who has the child for the greater number of nights that is the one that can make that $5,000 contribution for their household, if both of you file as single taxpayers. So as I mentioned, if you're married filing separately, the contribution limit is reduced to $2,500 for each person. These contribution limits are for 2025 and apply per household, not per account. So if you and your spouse both have access to a dependent care flexible spending account through your employer, your combined contributions cannot exceed the IRS set limit of $5,000. There are other limits to contributions depending on your employer as well as on certain circumstances. As physicians, we generally qualify as a highly compensated employee, which can lead to a lower contribution limit to our employer's plan. This is a limit set by your employer's plan and not by the IRS. This means that if your spouse is not a highly compensated employee and has an employer-offered dependent care FSA, then your spouse can contribute the $5,000 to their dependent care FSA if you're married filing jointly, and they earn more than $5,050, or they earn whatever amount they plan to contribute at their job. You can elect how much money to contribute, if any, to a dependent care FSA, either when you start working for a new employer or when you're enrolling in your employer's offered benefits during the open enrollment period, which usually happens in October or November for the following calendar year. If your employer uses a plan from July 1st to June 30th, then your open enrollment period may be in April or May. Participation in a dependent care FSA is not automatic. You must re-enroll every year and decide the amount of your contribution every year. Once you decide the contribution amount, the only way you can change that amount is by having a qualifying event, such as a marriage, birth or adoption of a child, death of a dependent, divorce, or a change in your spouse's employment. The funds you contribute will be withdrawn from your paycheck, evenly divided throughout the year. Healthcare FSAs are pre-funded by your employer, meaning all the funds are available for reimbursement at the beginning of the year. This is different from dependent care FSAs, where you pay expenses out of pocket, then receive reimbursement based on how much you've withheld from your paycheck for those dependent care expenses. You can't get a reimbursement until the money actually comes into that dependent care FSA account from being withdrawn from your paycheck. So you won't get your last reimbursement until after your last paycheck. However, you can be reimbursed with your last paycheck any qualifying care that happened earlier in that plan or calendar year. Generally, any unused funds at the end of the year are forfeited. It's use it or lose it. That being said, there was an exception made in 2021 due to the COVID pandemic. Under the provisions of the Consolidated Appropriations Act, employers could allow all unused funds in 2021 to carry over to 2022 and be used throughout the year. While healthcare FSAs may allow carryovers, dependent care FSAs generally do not. It is possible that your employer may allow a grace period from January 1st to March 15th, where you can use funds from the previous benefit year to cover eligible expenses if you do have leftover money at the end of the year. The funds in a dependent care FSA can only be used to pay for qualified dependent care expenses. So let's talk about what the funds in a dependent care FSA can be used to reimburse for, which basically asks the question, what are qualified dependent care expenses? So this includes both in-home care, such as a nanny or babysitter, who is covering for a single parent who's working or both parents who are at work. It does not cover the situation where childcare is needed to free the parent or parents for any reasons other than work that provides income. It can't be used to pay for a babysitter for date night or even to do volunteer work. Tutoring expenses are not eligible, and you can't pay your older teenager to babysit their siblings and get reimbursed from your dependent care FSA account. You can use your dependent care FSA money to cover care provided outside the home, like a child or adult daycare service provided by qualified caregivers. It can be used for before and after school care, as well as summer day camp, but not for private school tuition or for summer school. Physical care is also a qualified expense. Publication 503, published by the IRS, explains the tests you must meet to claim the credit for child and dependent care expenses. You can find that online at www.irs.gov/publications/P503. And I'll have that link in the show notes as well. It's actually very detailed on what services are covered. For example, expenses you pay for household services may meet the work-related expense test if they are at least partly for the well-being and protection of a qualifying person. This could include the services of a cook or a cleaning person if the services are partly for the care of the qualifying person. Before setting up a dependent care FSA, consider comparing its potential tax benefits with the child and dependent care tax credit. The percentage of eligible expenses that qualify for the tax credit varies depending on the taxpayer's income level and the total dollar amount of the cost. Generally, for people in higher tax brackets, the dependent care FSA will provide a larger tax benefit than the child and dependent care tax credit. Again, I'm not a CPA, and this is not professional tax advice. Honestly, when I thought about doing an episode only on dependent care FSAs, I actually thought it might be a short episode. It wasn't until I dove more into what qualifies and what doesn't qualify that I realized just how involved it can be. This is an example of the complexity of our U.S. tax code. If you are a single parent or in a dual income household with young children, it's probably very easy to have more than $5,000 in expenses that are eligible for reimbursement from a dependent care FSA. So if your employer or your spouse's employer offers this option, this can be a great way to essentially lower your taxes. Even if your youngest child is 12, you could potentially use the account to reimburse the expense of your household cleaner, which I think sounds great. I hope this episode brought some value and you got something out of this episode. Stay tuned to the Grow Your Wealthy Mindset podcast because I'll be back next week with another episode. Have a great week. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician, so if you need any medical advice, please contact your own physician. Thank you. Don't forget to pick up your guide, 12 Financial Mistakes That Keep Physicians from Building Wealth. You can grab that guide at my website, www.growyourwealthymindset.com/12 financial mistakes. You'll also find that link in the show notes.